You can't think of a stock as something different. You value a business, and then you divide by the shares outstanding. But what you have to think about is what kind of a business are you getting into, what are its economic characteristics, who are its competitors, what's its management like, all of these things that relate to a business instead of a little ticker symbol. I used to know when I was 11 or 12 the ticker symbols of every company virtually on the New York Stock Exchange. I could mark the boards at Harris Upham, but I didn't know anything. I mean, I knew that X was U.S. Steel and T was AT&T and so on, but I didn't know anything. I didn't know what was behind them. So I had to start looking at these little symbols or these little names in the paper as businesses and decide, how do you value a business? What counts? The second thing in the book is that Graham gives you a marvelous set point in terms of how the investor should react to stock market fluctuations. He talks about his mythical Mr. Market in chapter 8. And there's been no better thing written in terms of the investor's attitude toward stock prices. Most people react the wrong way to stock prices. I mean, they feel good when their stocks go up, they feel bad when they go down. They think the stock market is there to instruct them. And Mr. Market is this partner you have in investing. He's a remarkably obliging partner. This guy comes around every day and he tells you what he'll pay you for your interest in the business or what he'll sell you more at the same price. Nobody ever does that in private business. If you and I owned a gas station together, and I said, every day I want you to come in and offer me your half interest in the station, and I can either buy your half or sell you my half at the same price, and you have to come in every day and do it, you'd be at a terrible disadvantage. And you'd be at a particular disadvantage if you're Mr. Market in the market, because Mr. Market, our friend in the market who obligingly gives you those figures every day, different figures at the end of the day and the start of the day, but he's naming a price at which you'll either buy or sell. The beautiful thing about him is that this guy is an alcoholic manic depressive. I mean, he is as unsound as they come. He wanders around all day, and looks at the crazy things, and he's going to name all kinds of crazy prices. And you don't have to pay any attention to him, except when it's to your advantage to do so. If that's once a year, if it's once every 5 years, it's one stock out of 3,000. All you have to do is sit there. You have no moral responsibility to this jerk. He is naming these numbers. You didn't ask him to, but he's doing it. And all you have to do is pick the one time when he is particularly depressed or particularly manic or particularly drunk or whatever it may be. And the market will be all of those things. And you take advantage of it. And that's what's remarkable about stocks, if you think about it, is that if you look at the high and low on all of these American companies for the last year, you'll see case after case after case where the high is twice the low. Now that's for sound American businesses running along, paying people, selling goods, and so on. If you go out and look at farmland 10 miles from here, there's no way in the world over a year that the farmland is going to range in value from X to 2X. It maybe go from X to 110% of X or vice versa. If you look at an apartment house near here and figures on essentially apartment houses like that over a year, it won't move 10% in a given year. But here are the finest of American businesses, and people just name these numbers that go all over the place. And you don't have to play, except when you want to. That's the important thing, and that's what Graham tells you. The market isn't there to instruct you, to tell you anything. The market is there just basically to serve you when you want it to serve you. One of the most important things to remember in stocks